Introduction. Understanding how and when to recognize revenues and expenses is central to accurate financial reporting. The choice between cash basis and accrual basis accounting significantly influences the timing of income and expense recognition, thereby affecting the financial statements and business decisions. This module explores the key features, advantages, disadvantages, and applications of both accounting methods. Learners will develop a nuanced comprehension of each approach, enabling them to select and apply the appropriate method for different business contexts.
Section 1. Overview of Cash Basis Accounting 1.1 Definition and Core Principles. Cash basis accounting recognizes revenues and expenses only when cash is received or paid. It records transactions strictly on cash inflows and outflows, without regard for when the underlying economic events occur. Revenue recognition, recorded when cash is actually received from customers. Expense recognition, recorded when cash is actually paid out. 1.2 Characteristics of cash. Basis accounting. Simplicity, easy to understand and implement, suitable for small businesses with straightforward cash transactions. Focus on cash flow, reflects actual cash position at any time, helpful for managing liquidity. No receivables or payables. Does not record accounts receivable or accounts payable. Transactions without cash flow are ignored. Tax reporting. Some tax authorities permit small businesses to use cash basis for tax purposes. 1.3 Advantages of cash basis accounting, ease of use and lower record-keeping costs. Section 2. Overview of accrual basis accounting. 2.1 Definition and core principles. Accrual accounting recognizes revenues when earned and expenses when incurred, regardless of cash receipts or payments. It aligns with the revenue recognition and matching principles introduced in Module 1. Revenue recognition, recorded when goods are delivered or services rendered, even if cash is not yet received. Expense recognition, recorded when costs contribute to revenue generation, even if not yet paid. 2.2 Characteristics of accrual basis. Accounting recognition of receivables and payables. Records accounts receivable and accounts payable to reflect amounts owed and owing. More complex, requires adjustments such as accruals, deferrals, and estimates. Provides a more accurate picture of financial performance and position. Required by GAAP and IFRS for publicly traded and larger entities. 2.3 Advantages of accrual basis accounting.
More precise matching of revenues and expenses, enabling better profitability measurement. Improved financial analysis, budgeting, and decision-making due to comprehensive data. Complies with regulatory and reporting standards. Provides better insight into future cash flows and business obligations. 2.4 Limitations and challenges. Complexity in implementation and understanding. Requires more extensive record-keeping and accounting expertise. May obscure actual cash flow, possibly hiding liquidity issues. Adjusting and closing entries increase workload and risk of errors. 2.5 Suitability recommended for medium to large businesses, companies seeking external financing, publicly traded companies, and organizations required to comply with GAAP or IRA. Section 3. Detailed comparison between cash and accrual accounting. In this course we will be using aspect, cash basis accounting and accrual basis accounting in our table. 1. Recognition of revenue when cash is received when earned, goods services delivered. 2. Recognition of expenses when cash is paid when incurred, matched to revenues. 3. Complexity. Simple complex, requires adjustments. 4. Financial statement accuracy limited, may misrepresent financial health. More accurate reflection of business performance. 5. Compliance often non-compliant with GAAP IRA required for GAAP IRS compliance. 6. Recording receivables payables not recorded, showing true obligations and claims. Tax implications may simplify tax calculations. More complex tax reporting. Suitability. Small, cash-focused businesses, larger, regulated, or publicly accountable firms. Section 4. Accounting for transactions under each method. 4.1 Example, sale on credit of 100,000. In this course we will be using transaction event, cash basis treatment and accrual basis treatment in our table. Isa, sale made on credit, no entry until cash received, revenue recognized immediately on sale. Dalawa. Cash received after 30 days, revenue recorded when cash is received. No additional revenue entry, already recognized. 4.2 example, expense for utilities 20,000, paid next month. In this course we will be using transaction event, cash basis treatment and accrual basis treatment. Isa. Utilities incurred, no entry until cash paid, expense recognized when incurred. Dalawa. Payment made next month, expense recorded when cash paid, no additional expense entry, already recognized. Accounting for transactions under each method. 4.1 example, sale on credit of 100,000. In this course we are using transaction event, cash basis treatment and accrual basis treatment in our table for today. Isa, sale made on credit, no entry until cash received, revenue recognized immediately on sale. Dalawa. Cash received after 30 days, revenue recorded when cash is received, no additional revenue entry, already recognized. 4.2 example, expense for utilities 20,000. Paid next month, transaction event, cash basis treatment, accrual basis treatment. Isa. Utilities incurred, no entry until cash paid, expense recognized when incurred. Dalawa. Payment made next month, expense recorded when cash paid, no additional expense entry, already recognized. Section 5, transitioning between cash and accrual accounting. 5.1 reasons to change methods. Business growth requires GAAP compliance. Seeking loans or investors who demand accrual accounting. Tax considerations or regulatory requirements. Desire for better financial insight and planning. 5.2 process for transition. Review opening balances for receivables, payables, accrued revenues, and expenses. Record adjusting journal entries to bring financial statements in line with accrual accounting. Update accounting policies and procedures. Inform stakeholders and tax authorities of the change. Ensure staff training on new accounting practices. 5.3 challenges. Increased workload and complexity. Need for accurate historical data. Possible tax implications during the transition. Section 6, impact on financial statements. Balance sheet. Accrual accounting shows receivables and payables, cash basis does not. Income statement. Accrual basis matches revenues and expenses to periods, giving clear profit picture. Cash flow statement. Both methods require cash flow statements, but the cash basis income statement resembles the cash flow statement closely, while the accrual basis does not. Section 7, practical considerations and decision making. Evaluate business size, complexity, regulatory environment, and stakeholder needs. Consider cash flow stability and the need for credit management. Assess staff capacity for managing more complex accounting. Understand implications for tax reporting and compliance. Balance simplicity against accuracy and transparency. Summary. Choosing between cash and accrual accounting is critical for reliable financial reporting and business management. Cash basis accounting offers simplicity and a focus on liquidity but can distort financial performance. Accrual accounting, while complex, provides a more accurate reflection of economic events and is essential for compliance and strategic decision-making. Understanding the strengths and limitations of each method empowers businesses to select the approach best suited to their needs and regulatory requirements.